Hello, everybody. I'm your host, Derek Bird, here at StopStrugglingNow.com. And today, I'm very happy to say we're going to be talking about building some wealth. That's right, we've talked about it before, but this time, you might want to pay attention. We talked about making money. We talked about gaining assets. We've talked about stocks and bonds, but this time, we're going to start talking about this thing that they always talk about, be your own banker. That's right. Don't have to worry about getting loans from anybody, but it's going to take a few years to make this work. You already invest in your 401ks, hopefully. You already have money going to the pension plans, Roth, IRAs, all kind of little different ventures. But we're going to talk about something that's unique. Some of you may have heard about it before, but please stay tuned and like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back. And how can I forget, before we get into it, the merch. That's right. We have the t-shirts available, motivational t-shirts, hoodies. Please go to StopStrugglingNow.com and see the SSN merchandise logo or in the description down below. And I'm gonna get this on screen, so stay tuned. So we're gonna talk about this be your own banker, infinite banking. Some of you don't think clearly. Some of you have heard me say, why are you out here buying cars for $700, $800, putting in $70,000 for something that goes down in value? Well, did you ever wonder why banks can go out of business, but have you ever wondered why insurance companies rarely go out of business? There's a definite reason. We're going to be talking about it today. Whole life insurance with dividends. Guaranteed almost. I don't really like to say guarantee, but if you're gaining 4% or 5% a year, you know that's not in the bank account. But how many of you knew that that could be in an insurance policy? That's right. We're going to talk about it, so I'm going to have to cut to the screen and show you some compound interest, some dividends when you start adding it on top, and then you have a plan, a creating wealth plan. When you're putting out, let's call it like it is. How many people have car payments of $300 a month, $400 a month, or more? And you're being charged 3%, 4%, 7%, whatever the interest rate is. You're paying that to the bank. You don't get none of that. But now, what if you paid yourself $300, $400, $500 a month for a couple of years? And then you were able to borrow the money. You're hearing me. Borrow the money, but yet still earn interest on your total amount that you put in there. And I won't say total amount because that's the incorrect language. But what I'm trying to say is, imagine being able to have $10,000 sitting somewhere, rolling in saying, I want a $5,000 loan, and still receiving compound interest on the $10,000. Yeah, we're gonna talk about it. That's right, 1%ers. Ordinary citizen can do this, but nobody tells you about it. So let's cut to the screen and I'll start going over it with some illustrations. It makes it a lot easier than me trying to explain this. I've been trying to figure out how to explain this for weeks, months, in a simple format, but it's kind of difficult, but we're gonna go for it. So hopefully some of y'all understand what I'm saying, and we're gonna start creating wealth for a lot more people. Let's get to it. All right, welcome back. This is probably the most important video I've made to date. So if you're here, please sit back, relax, and pay attention, because this is talking about creating wealth for you, your family, and generations to come. It's a mindset change. Think about it. Have you ever thought about how very wealthy people have homes that are sitting empty, and somehow somebody's paying for the gardening, the upkeep of the interior, the upkeep of the exterior, and they're just letting it sit there and sit there? There's a reason.
There's also a reason that, for instance, wealthy people do not want to turn over their tax returns, because then you're going to see something that is crazy. You'll see things such as loans in and out of their accounts, and then you'll find out they're not paying tax on the money. So how would you like to not pay tax on your money? So we're going to start about something just basic mathematics that people don't understand. And you'll understand now why I get disgust for when people are out here saying, I bought $100,000 car that goes down. I put down 30 grand, 40 grand. I'm leasing a car. I'm putting down $700 a month, $500 a month, $400 a month. All this is going to come to roost. Because why? We get taxed for everything. That's taking away your wealth. You see, I'm in the dark mode on the Stop Struggling Now YouTube page. You're going to want to share this video. You're going to want to have your family, your cousins, your brothers, your mother, your father, everybody watching this video. Now, with all that said, this is about economics. I am not a CPA. I am not an insurance agent. I'm not any of that. But I was lucky enough to have an office in a building with an insurance agent when I was around 27, 28 years old. One day, he starts seeing some volume of business I'm doing, and he walks in my office and he says, hey, Eric, do you know you could be a millionaire in about 10 to 15 years or less? So I'm sitting there like, okay, yeah, right. I've heard of this get rich quick scheme and stuff before. And he's like, oh, no, I got something. You got to come down to my office and talk to me. So he starts telling me about this whole life insurance, and I'm like, man, I don't know. But anyhow, this is major. This is going to help you, your family, and future. And it does not matter if you make $10,000 a year, $20,000 a year, $30,000 a year, or $250,000 a year. Everybody can participate in this, and some people may know it as banking on yourself. Some people call it infinite banking. Some people call it do what the Rothschilds do. Do what the Rockefellers do. Here we go. Let's start out with the basics. And we're in the dark mode because I needed these calculators to be up on the screen today. So let's just start out the box. There's people here who are sitting there, and I'll use this. You all have heard it before, where people say I paid for my car in cash, and they think that's a big thing to do, but in reality, a car goes down in value. So is that really a good thing? But I'm going to show you something else. So let's just say, for the sake of argument, that I have money in an account, and the money, we're talking about $20,000, is earning 4% compounded. Okay? So what I want to show you is, on the right-hand side over here, you can see I just lit it up. $20,000 at 4% compounded. It comes out to 60 months. That's 20 at the end of 5 years. You have $24,420 in your account. You haven't touched the money. Well, here's what happens if you're buying a car with cash, or using your money cash, where people use this thing about cash is king BS. Well, see, that's not really true. These colloquialisms that they use is for the working class to stay working class. Because what most people would do is they'll take the $20,000 and they'll say, okay, I'm going to go buy a car, for instance, or I'm going to go buy any object, any shiny object that does not create additional income. That's what most people would do. Well, see, once you take that money out, you now, in order to get this same savings, you have to save another 20 grand. So we'll carry it further. We're going to go buy a car. So we roll in and we go up to the loan office, and we say, hey, man, I need a loan for a car. They say, okay, Eric, we're going to make it, we'll give you a loan, 6% interest. So you see on the right side over here, that I got 6%, and we got a 5-year note, so that's 60 months. Look at here. That cash that I just took out or did not take out, I left my money over here. And I went down and got a 6% loan. Now, some of you would say that's high. I know it's high. So you can get 2.9, 1.9, 3.5, things like that. I have loans at lower than 6%, but I'm going to use one at 6%. Now, on the left-hand side of the screen, you see what our payments are going to be? $384.73 a month. And so you're going, Eric, I can afford that. That's right. You can't afford that. Now we're going to put this over here, $384.73. And we got 60 payments. Look at here. The loan balance. This is the total that you paid, $23,000. If I leave my money over here, I outgain even the 6%. So why would I take this $20,000 out and buy a car? I would not. I'm leaving the $20,000 in here, right? I earn more money with my money still sitting here than if I pay the car. I come out ahead. Most people don't grasp this idea, right? You're thinking, wait a minute, why should I get a loan again? Well, there's a reason I'm going this illustration, because imagine this. Imagine if I had $20,000 sitting somewhere, and imagine I wipe this first box off and the second box off, and imagine if I can still borrow $20,000, this money sitting over here, but yet I'm still earning 4% compounded as if I have $20,000 in there. That's right, you're hearing me right. And I'm borrowing the money, maybe it's 5% one-time fee, maybe it's 4% one-time fee, but the fact of the matter is I can take out 20 grand, borrow it, called a policy loan. You're going to learn all about this. And yet it's as if the 20,000 is still there, so I'm still going to be earning this interest. And meanwhile, I can turn, instead of paying the bank the $384 a month, if I wanted to pay myself 6%, I could just pay and put the money back into this account, $384.73, and guess what's going to happen? Instead of me earning 4%, it could be 10% on my money. Because now I'm adding the interest off. Welcome to banking, ladies and gentlemen. You could be your own bank. Instead of borrowing from the bank, borrow from yourself. Now, of course, you're going to say, Eric, I don't have 20 grand. I understand this. But there are some people that do have 20 grand. There's some people that have 50 grand. There's some people that have 150 grand sitting around. And what are they going to do? They're going to invest into some other vehicle, which does not have the same power. So now, like I said, if you want to pause this video, get yourself a glass of water. In fact, it's almost a celebration. Get yourself some champagne, a glass of wine, or whatever other mixed drink you like, because you're going to bring your family around this video and say, oh my God, I've been thinking of things the wrong way. I've been screwed. The U.S. government has been giving me propaganda on how to become rich. And how do they do that, ladies and gentlemen? Okay, well, here we go. I'm just going to go with history and what we call World War II economic expansion. After 1945, 1946, 1950, we had the biggest economic boom in history, the growth boom. The reason why? Because we had to build factories. We had to get people to work in those factories. Previously, women would kind of like stay at home, and the man would be able to make enough to go out. Well, because there wasn't enough population to be in these factories for this war effort, we had to bring the children, the women, everybody in, because we needed people to produce airplanes, boats, trains, automobiles, the whole bomb making. All of this had to be done. And once the war was over, we had these manufacturing facilities in place, which now can be turned from bomb making, airplane making, into agricultural, right? Could be turned into consumer products, because now these factories and everything is built. And this is why we have a huge expansion. Now all of a sudden everybody can afford to live in a house, the golden dream. Save your money, work for 30 years somewhere, get your golden watch, get your pension. Isn't that your story? But let's go back before that. The first part of the story is go to school, get an education, get a college degree. Whole different thing when the college costs, and let's say in today's money, if you can go to school and it costs you $200 a semester, that's a big difference than costing $10,000 a semester, right? And having to borrow money. It was a whole different thing. They wanted people to be very smart. They wanted people to learn, educate, science, engineering, because down the road, we're competing against the rest of the world. Germany was just defeated. But in the meantime, we still got to worry about Japan, China, the rest of the world, and Russia. They have scientists too. We're trying to be number one around this whole thing. So therefore, this is why America had this expansion. And this is why you were brainwashed into believing paying taxes is a good thing. It's American. That's right. Go to work and have 30% of your funds siphoned off. And some of you will go, hey, Eric, 30% doesn't come out of my check. I suggest you go look at your FICO. Okay? Go look at that FICA. Then you're going to say, okay, it looks like 20%, 25%, something like that taken out. Then I'll do you this. When you go get your groceries and you buy $25 worth of groceries, well, we can only be so lucky. This ain't 1950. So when you buy $125 worth of groceries, there's tax on there. Think about it. There's taxes. When you go down and buy a house, aren't you paying taxes? Property tax? There's taxes. You have a cell phone. Your bill's $40, is it? There's taxes. Or is your bill $37 and they're adding the taxes to make it $40? Imagine if you didn't have none of those taxes, right? So you're thinking I only pay 25% or 20%. No, wrong. You're paying like 35%, 34%, 38% on your money. And when you make like 60% of the population less than $40,000 a year, that little siphoning off of taxes, 30%. It's $12,000. That leaves you with $28,000 in essence, which is less than $2,000 a month. You can't even get an apartment at that point. So therefore, 2 people in the household have to work. I'm using 60%, but let's just take the upper echelon, the middle class, the upper middle class, 70, 80 G's. You're not immune. You're still getting taxed. I'm going to keep this going, ladies and gentlemen. We're going to get to it. But please stay with me because this is the most powerful video I've probably made in a year and a half. Let's get down to your brainwashing. And by the way, I'll give you something straight out the box. DCU is a credit union, and you are taught to save money. The problem with saving money right now is that most banks, they only give you what, 0.01% if you're lucky in your savings. You can't get savings anywhere. So DCU. .org. There'll be a link down below. You can hit me up at eric@stopstrugglingnow.com and I can give you a referral link so you can sign up with DCU. And the reason why you want to sign up with DCU is because 6% interest on your money. It's only on balances up to $1,000. You can start with $5 minimum. But what you're not understanding is while you're sleeping, the money's working for you. This is the whole concept on what you want to do. While you're sleeping, you're making money. Okay? So this is what I'm trying to tell you. This is a start, and once you get over, like if you put in $1,000, you're going to earn 6.17% APY over the year because it's compounded. So once you have the $5.40 this month, after you have 1,001 or more, they give you like 0.025, I believe. But the fact of the matter is, it's compounded additionally, so eventually you get up to $6 a month, then 7, then, but it takes a year or so. But the idea of compound interest is one of those streams of income. Income interest is a stream of income. So we're going to get to it. So we're going to keep talking about it. Now let me start the thing off with, I'm going to go to this screen I didn't want up first, but we'll stay here. The banking system. Once again, you can see on the screen here, I'll have links to this. Fractional reserve banking is the biggest frauds of mankind. You want to know why? Well, most people don't understand how it works. I go down and deposit $1,000 in the bank. I have $50,000 in my bank account, allegedly. I roll down to the bank and I say, hey man, I want to withdraw 20 G's. You know what the bank tells me? I'm sorry, Eric. You got to make an appointment. You just can't get that right now. That should tell you something right there, ladies and gentlemen, because what they're doing is because of the fractional reserve system, they're only going to keep $100 in the bank. Okay? On paper, you or I would still have $1,000, but they're loaning out $900 because they only have to keep 10% of that money in the bank. The $100 is all they got to keep in the bank. Are you understanding me? In other words, the bank could get $1 million in deposit. They only have to keep 100,000 of it in the bank. The rest of it they can go off and play. They can do whatever they want with it. And it's legal. If you or I were running this type of business, we'd be called a drug dealer. Come on. We'd be locked up in jail. We would be right. It's like printing up stock certificates and saying it's worth a certain amount, but then we're telling other people, yeah, it's only worth 10%. But we're selling it for 90% more. Come on. Think about it. So you can see this cycle right here. So we'll go with number one. 1,000 in the bank, reserve 100. They loan out 900. You can see right here, $1,900 is on a digital screen in the system because now another person got $900. So you're saying, I see you, Eric, no biggie on that. But here's what goes down. That $900 goes into another bank and they repeat and wash the same thing. So now each person, this person, let's call it me, Eric, put in 1,000. Jane goes to the bank and she says, I got $900. That's $1,900 from my $1,000. And both banks say, we both have 1,000 in the bank and 900, but the bank only has 100 here and 90 there. The banks only have 190 in the bank. So now they're using that same $900 and they're loaning out $810. Are you not getting this? Now, this is why this little illustration right here, this money, which is ours, that you think is real, goes into this bank and they literally turn it into nothing. What an awesome plan. This is what the American banking system is. This is what central banking is. This is what Fed banking is. Are you not mad yet? Are you not understanding your money's being siphoned from taxes? Your money's being siphoned when they're printing up additional money and putting more money in the money supply that isn't there. That means your money is worth less. That's why there's inflation. This is why things have to cost more. There's more money available. All right. You know I like this. So here we are. We're on the three kinds of people when it comes to money. Borrowers. They don't have enough money, so they borrow to live their lifestyle. And by the way, when you're borrowing, you're paying these people interest. So for the luxury item that you just got, you're willing to pay 6%, 3%, 16%, 19%. Whatever you're willing to pay, that's what you're paying. And you're happily doing it because why? You got the nice shiny TV, the big washer and dryer, the big car. You don't care. But all that money's taking away your wealth, ladies and gentlemen. turn it around. Cash buyer that we already went over. He thinks, oh, I paid everything cash, puffing his chest out, going, ha ha, look at what I did. And I just illustrated to you, you might as well have kept your money in there and earn compound interest and go down and get a loan and use that money to invest in something, which compound interest is investing. Or that same money could have been turned over into a FHA property, and now you have an additional $1,000 coming in, except one problem. That $20,000 is gone still. And so now that $1,000 a month that you're getting in is the only way that you can replace that $20,000. And once again, with the whole life insurance dividend product, you can borrow the $20,000 and still have it earning interest while you're going off doing your real estate deal. And now you didn't have to qualify. It's no qualifying policy loan. You don't need anybody's money. Again, Rothschild, Rockefeller, and other wealthy people. This is what they're doing. Now, the wealth builders. So you could see right here, we'll go down through this cycle. The positive wealth curve. Yeah, if you could keep your money and earn interest, compound it 4% a year, beautiful, right? Falling off the wealth curve. The reason why you fall off is because you're borrowing money. So what happens, this interest, it takes away your wealth. That's what I'm trying to tell you, ladies and gentlemen. So you're thinking you're out here buying cars and you're paying the interest, fine. But that money could have been going on this wealth curve here into a policy that has compound your money, whether you borrow against it or not. You're still earning the maximum amount. We're going to get into it. And then the cost of falling off. You can see the difference. This is what I'm referring to right here. Because you're willing to get credit cards, car loans, mortgages. You're sitting there going, okay, I'm sacrificing my future 20, 30, 40 years from now so I can have these nice little necessities right now. My daughters used to always say, hey, Dad, you're embarrassing me. Why you got these cars out here that you know, they're old. They don't even look nice. You don't even care about fixing them up. My responses was always, excuse me, cars don't go up in value. So why am I sitting over here trying to do this fix-up stuff? And second off, they're free and clear. So that means there's more money in my pocket earning somewhere else. So therefore, that was the funniest thing, and that's what everybody can't understand. Are you able to withstand the scrutiny, the ha-ha, that everybody thinks that because you don't have a fancy car, like you heard me talk about before, because you don't have a big house, that equates to wealth? How many of you know some old guy that passed away and all he ever did was just basically come out, water his lawn, drive a 10-year-old car or 20-year-old vehicle, and his house was just ordinary, 3-bedroom, 2-bath in a mild neighborhood. Next thing you know, the dude has millions of dollars in a wall, in a safe, at the bank. The kids are arguing over $2 million. It happens. And there's a reason, because they find out that this whole time he put his money in vehicles that was earning money while he slept, compounding monthly, compounding yearly while he slept for the 10, the 20, the 30 years, quietly accumulating wealth while the family didn't know nothing about it. So now the family's going to know something about it. And speaking of the Federal Reserve, just so I can prove my point, and if I can't pull this up, we'll find out. But the fractional banking, you can see here, February 21st, these are billions of dollars, 4.5 billion, 26 billion, and 26 billion was accepted on the 21st. Oh, that wasn't enough. 3 more billion on the 20th. That wasn't enough. How about 40 billion on the 20th? So are you not getting what's going on here? They have to print up money because of fractional banking to throw money in the situation in the United States to make sure the banks are still liquid. Because if everybody ran down to the bank, not even everybody, if 40% of the people ran down to the bank and said, hey, I need my money, they don't have the money. They only have enough money for 10%. Are you getting it yet? So you don't want your money there, do you? No. So we're going to use this old adage of what happens when a penny doubles. So I want you to keep thinking about this. This is where people's mindsets are crazy. They're like, hey, I'm saving money to buy something. So imagine the penny doubles every day. Imagine at the 22nd day when you have $20,000 in here and you say, oh, I saved enough money. I can go down here and buy whatever it is I wanted to buy. Well, guess what, ladies and gentlemen? You just took the $20,000 off the table. Now you have to start over all again. This isn't earning any money for you now. So you can't get up here to the $5 million mark at day 30 because you took the money out. You have to start all over. That's an uphill battle. That's what you're doing here in America. And now, the infamous 401k. Looky here. How many of you banked with Fidelity and opened up your 401k last week and saw zero balance? Yeah, that digital screen that said zero, you probably had a heart attack. You said, what the hell's going on here? No money in my account? Well, it happened, ladies and gentlemen. This can happen. The Great Depression, this is exactly what happened, except they didn't have digital back then. People had to find out when they went to the bank that their money was gone. Swiped. Bail in. Now, I have a friend, and a lot of friends, who have worked for 20, 25 years for the same place. And they have done what the American Institute of the United States says. Brainwashed you saying, hey, you know what? Put a little bit of money in a 401k. It's tax deferred. You don't have to pay taxes on it right now. And you're like thinking, oh, this is great. My taxes are going to be less when I get older. Ladies and gentlemen, because there's things called tax cuts by the federal government. And just because they did a tax cut, you may find out that they took away deductions and now your tax bill is more because they're going to have to figure out how to pay the deficit. They're going to have to tax you more. So just because your tax rate in 2005 was a certain number, your tax rate's going to be higher in 2020 or 2025. Let's just face facts. But let's stay on the path. 401k. You're sitting here going, all right. Like a friend of mine, I told you before, says I got $1 million in my 401k. Right. Great. 20, 25 years of putting $200, $300, $400 in your bank, the mutual fund company siphoning off 1% or 0.05% every year. You don't pay no attention. You're just thinking, yeah, this money's sitting in there earning. It's earning all right for other people. So you're saying, all right, 401k, I got $1 million. Well, guess what, ladies and gentlemen? Every time you withdraw, whether you withdraw early or you withdraw when you're 60, that is called income. You're going to pay the tax on whatever the tax rate is now. So let's say it's 20 years ago and it's the year 2000. And let's say the tax rate at the time for being 60 years old is 15%. Well, the tax rate now could be 18%. The tax rate could be 10%. But the fact of the matter is it's not. You're going to have to give up 30% of that money. If you said I want $1 million all out in my bank account, that's going to be considered income. You might as well give up 300 G's. Just say bye-bye. And you didn't have to do that. But yet, you've been brainwashed, save money, retire. You'll have money sitting there. We'll send you some Social Security, which may or may not be left. The Social Security Administration, they borrowed money already. They are not paying it back. So You may not. I mean, the millennials, if you're 25, 30 years old, there may not be any money in the Social Security fund to give you any. Now you're thinking, I got my money in a 401k, and now you're finding out, oh, sheesh, I'm getting taxed later. Now, when I'm 90 years old, or not 90, but I'm 60 years old, 65 years old, I don't make the same amount of money as when I was 35, 40, 45 years old. You make less. Now, when the money is more important to you, you find out it's not going to be good enough. Because if you're 60 years old, for instance, and you have $700,000 and you live another 20 years, start doing the math, ladies and gentlemen. That it is not that much. Divide it by 20 years. What is that? 35,000 a year? Can you live on $35,000 a year right now? And you really think you're going to live on $35,000 a year when you're 61, 65, and you may have health care needs? I don't think so. So right here, I'm going to have this smart asset article because most people don't understand. See, when you reach this age, you're going to have to start. Down payments, emergency bills, education costs are some expenses people pay. So these are things that you don't think about. So now we get to the whole life insurance with dividends policies. Ladies and gentlemen, you know Walt Disney because of Walt Disney World. Some of you even know J.C. Penney because they're still around. Foster Farms Foods on the West Coast. Some of you know that. But how many of you know this? All these people were lucky enough to have the foresight by their family to have money in a whole life insurance policy. Now, there is a death benefit, as we call it. So you have life insurance for a reason. Let's just say you want $1 million life insurance. If you pass away, your family gets $1 million. Great. But while you're paying that insurance premium, how would you like to have something called cash value that you can borrow against? That's right, your own bank. So Walt Disney World, when he had his grand vision of the Disneyland theme park, the bankers were sitting there going, man, you're crazy. A mouse, a Minnie, and a Mickey with other cartoon characters? Get out of here with this nonsense. So some people gave him a little bit of money, but of course, they're like, this is so crazy, we're not going to give you all of the money. What did he do? He checked into his whole life cash value. His whole life insurance policy had a cash value. He lent himself his own money and became his own bank. You don't have interest on your own money. Now, sure, the insurance company is going to have a little fee for giving you that loan, but you don't have to qualify. You don't have to put any money down. You don't need good credit. You don't need credit at all. You don't need anything other than give me my money. And yeah, it'll come in 3, 4 days, 7 days, whatever the case may be, but it takes, a week or less. There'll be a check coming to you. You can deposit. And guess what else, ladies and gentlemen? It's tax-free. That's right, tax-free. You're not going to pay no tax on this money that's in your cash value account. J.C. Penney, stock market goes down in 1929. He needed access to capital. You can see it right here. Here's his story. So what does he do? He turns to his whole life insurance policy and says, okay, give me some of that money that I've been storing up in there. And here's the beauty of it. Even when you take the money out, you have a non-recognition type life insurance company. That means when you take the money out, I'll use a simple example. I have $100,000 in cash value. I say, hey, give me $50,000 a policy loan. They send me the check. My 4% is still being compounded on the full $100,000, even though only $50,000 is in there. And now what do? I use that money to create more wealth. I spend it not on car, not on TV, not on furniture, but on something that's going to create money for me. It's a loan to myself, and I'm going to pay back my loan. And I might even throw in a 1%, 2% kicker because I'm the bank now. I'm going to pay my bank back a little interest because I'm using income producing property or income producing business to pay back my loan. Are you getting it yet, ladies and gentlemen? And the full J.C. Penney story I was going to have up for you, but it's the same story. Dry goods store for mining and farm families. He was severely affected, as they said. He was set back. He's sitting there saying, oh my God. But again, you can see right down here, had accumulated massive wealth inside his cash value life insurance policies. And notice there's an S at the end because this is so powerful that you can have more than one policy, so to speak. You can have a paid in addition, meaning you can stack some additional policies on there. This is so powerful that people do not realize that Walmart, a long time ago, maybe 30 years ago, they would insure each employee with a whole life insurance policy. They didn't care. They knew nobody's going to pass away. But what they're doing was building up cash value. And when you have a guaranteed 4% compounded interest, they were building up all this cash value because, yes, ladies and gentlemen, you can own a policy on someone else. Except because of the Walmarts who was doing employees, they made a rule you can't do that anymore. Of course not, because obviously that created a massive amount of cash flow. So you're protected if the employee passed away, you get the death benefit from the insurance policy, and they could have a $100,000 policy or $1 million. They would get that, not the family, Walmart. And meanwhile, if Walmart ever needed some cash, they don't have to go to the bank. They could just say, hey, man, I want the cash value out of this policy, that policy, that policy, that policy. As they're building and making money, they just pay back the loans. And meanwhile, their customer or their employee still has the full insurance if they passed away. How much more do you need to know? You want to be a bank now, don't you? Don't you want to be a bank now? And for the last time, stay with me because I have people that's going to have a webinar at the end. I'm not going to do the webinar, but I'm going to have a link down below so you can have the webinar to Darius and Carmen. They're going to have a webinar, and I'm going to have a link to where there's another person. I always go with young cats because, like, my insurance agent passed away. So who do you really trust? You don't have any relationships with people, so you have to find new people. So Caleb Williams, I'm even giving him a little love. He's a young cat. He understands this greatly, but you can get an asset update from him. You can fill out a form, get a free deal from him, and he'll show you with minimum premium. So don't think you have to pay $1,000 a month. Don't think it all goes by your age. The sooner you start, the better. But you can start if you're 35. You can start if you're 45. You can start if you're 55. You're still going to live another 20 years potentially. You could have cash value building up as we speak. Day one. Some of you have 3,000 sitting around, 5,000, 10,000, 20,000 sitting around, and they could be earning 4% interest. And you can still borrow against it, part of it, because you still have to pay partial of your life insurance. So the beauty of it is you have life insurance coverage if you pass away, and you have cash value if you need it for your own banking purposes with no interest. All right. So my last illustration here, and we're going to keep going. So again, thank you for watching. Thank you for staying with me. The Amortization Calculator. This is all based on what I'm also trying to get you to understand. Everybody says, I want a house. This is the biggest ripoff on the planet. Everybody, because between after the war and up even until like 2000, home prices generally increased, and therefore people were able to refi their house. Even to this day, you have these HELOCs, home equity lines of credit, because if you have more value in your home than what you owe on your loan, the bank, of course, is willing to give you a HELOC loan. Of course, you're giving me interest for my own money, or money I don't even really have. Think about that. It's not even really money. So here's a situation here where it's not unreasonable. A $300,000 house is purchased, 3.8%. This is if you have a 700 credit score. Okay, let's face it, 700 to 720 or thereabouts, 740, whatever, you'll get a 3.8. Your payment is only $1,400 a month. So most people say, hey, that's better than my rental payment. Beautiful. But what you're not getting is you just traded in money that you actually have to pay the bank interest. And look here, after 30 years, that $300,000 is $503,000. And this is where you've lost me. Real estate long-term gurus talking about homes without being a rental is because if you as a person buy a home and it's been done before where you got a home in 2004 and you said, hey, I bought it for $300,000, $2,000, I bought it for $300,000. And now you roll down the street and you go, ha, 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 man, I'm loving life. My house is worth $400,000. First of all, you still live there. So what is it really worth? It's not worth nothing. But the worst part of it is the interest that you've been paying. You've already paid pretty much $400,000 for the house. You really didn't get ahead. And interest, and because of the escalation of how much things cost because of inflation, $400,000 can't even buy what it used to buy. And you're not even making any money. And then at the end of 30 years, you sit there and say, hey, my house is worth $500,000. Well, I hope so, because you actually paid $500,000. And you're thinking, oh, yeah, hey, everybody, I made $200,000. No, you didn't make jack crap. So get off this thing thinking that your house is an asset. It's not an asset. It's only an asset if you're able to turn that into money-making ventures from it. That's why Airbnb is powerful, or VRBO, or whoever else you want to rent out a room from. That's why this is so powerful. This is why the powers that be tried to, hold on, we got to make up some laws here. We can't have ordinary citizens being able to make money and then pay off their notes faster, because, of course, if you pay off your notes faster, they don't receive as much interest, which is the whole ball game. But imagine this. Imagine if you had $300,000 of cash value in your whole life insurance dividend policy. You borrowed that, a policy loan, and imagine the $300,000 plus whatever excess you had in there was still earning the 4, and imagine you just paid yourself back $1,300 a month. And now you're putting it back into your policy. Except there's one little difference. You're not really paying any interest on the $300. Zero. Well, the policy loan in some cases, depending on who you go through, you're going to have a simple fee, which is a 1 year and an interest from it. So, it could be you pay $12,000, let's say, for that. But so what? That's better than paying $203,000, and you'll pay it down faster because you're not paying down principal and interest. You're paying down principal. Almost all your money is going, 97% of your money is going toward principal from day one. Now you have a bank, ladies and gentlemen. You're creating wealth, ladies and gentlemen. And let's just get real. I don't want to go out and buy a house. I want to go buy a 10-plex. Let's get it real. Let's get it right. We want to have $1 million in that cash value. And you're saying, Eric, man, I'm not seeing this picture yet. How can I get there? You can get there. Think outside the box. Here you go. 5 steps to becoming your own banker with whole life insurance. I'm going to have a link down below, Banking Truths. And because of the Walmart scenario, There's a reason. Here are the types of relationships we'll give a whole policy for you to own and control as your own bank. Notice the key word here, control, because that cash value is what you control. And so you can have a policy on your spouse, your child, your grandchild, even your business partner, and a key employee, but you can't do what Walmart did before and have thousands of whole life insurance policies on 1,000 employees. Can't do that no more. So you can go here and learn some things. There'll be a link down below for this page, but I just want to let you know that I can get a policy on a spouse, on a child, on my grandchild. Of course, it costs less. Their policy costs less. So if your grandchild and you put $1,000 in his policy per year, I'm going to show you something. You're going to say, holy smokes, are you kidding me? That's right. I'm not kidding. You could have $200 or $300 a month put towards a policy for your grandchild. By the time they're 18, 19 years old, they're not sweating. You're sitting there going, wait a minute, does that cash value still, does that really say 80, 90, $100,000? Wait a minute, I only put in, I don't know how much I put in, but it wasn't that much. And now you control it as the person that got the policy for him. You could say, well, I'm going to use the $90,000 to invest in something that creates income, more wealth for the family. And not only that, you can call these things paid up additions, which means you can stack additional mini policies like child policies on top of it. You're going to learn all about this. Not by me. I'm not an insurance agent, but there's a couple of people that I gave you the names of, Darius and Carmen. I like what they're talking about. And Caleb, I like what he's talking about. I'm going to give you them too. There'll be a link down below. You can go see them. They'll help you out and get you straight. So don't be scared. You don't need to make that much money. You just got to start. And then you go by what you're actually trying to do. And you're not really trying, this is not short term. How many of you have 401ks that you're putting money into every month and you're sitting there waiting until you retire? So you're willing to wait 20, 30 years. So why aren't you willing to wait 4, 5, 6 years on yourself? Again, we're only talking about 5 years. You don't even have to wait in reality. If you have a lump sum that you can put in immediately, you'll have a cash value on that. I'm going to show you that too. I'm kind of excited, as you can tell. So again, that life insurance for children thing. Children. And those people who are trying to create wealth, you have an LLC, you have a corporation, you have an S-Corp, whatever you want to call it. You can do miracles when you know what to do and you have time. Even if you're 60 years old, you have time. Your in America, your average age is 77 to pass away for men, 79 to pass away as a woman. That means you still are going to live on average anywhere from another 15 to 25 years. And as you get older, you don't make as much money. And so therefore, this is how a lot of senior citizens are in poverty, because they're relying on whatever little kibbles and bits that the Social Security Administration gives them, the Medicare, Medi-Cals, the Medicaids, the pension funds, if they're still around. Like I keep saying, Sears employees, they've worked there for 20, 30 years. Their pensions are trying to be siphoned off. These are the kind of things that you have no control over. This right here is not a bank. This is a savings plan. This is not a bank. If the stock market goes down, you still are going to get your 4%. The stock market goes up, you still are going to get your 4%. This has nothing to do with the stock market. These insurance companies have been around for over 100 year. They're not going anywhere. Why? Because you have money that you put in there. A lot of people are doing this policy loan, so they get their extra 4%, 5%, depending on what company you're at, for simple fees. They know people are going to pay back their own money, because if you don't pay it back, then that money will be taken against when you pass away. So if you had a $1 million life insurance policy and your cash benefits is $700,000, and for, let's say, the sake of argument, you decided to take out $700,000 and not pay yourself back, well, when you pass away, your relatives will get $300,000. But again, that's the beauty of it. You still have life insurance in case something happens. So your family still receives money. And the whole time, your family could be using this cash values and creating wealth, more wealth. Rockefeller, Rothschilds, this is how they do it. And now, stop struggling now way. Okay, ladies and gentlemen, we're going to start with this child because I'm trying to break it down because this is what you're going to be seeing when you talk to a whole life insurance agent. And you're going to say, hey, I want that whole life insurance with dividend cash value, and they have different plans. They're going to have a, whole life 10-year, whole life 20-year, whole life lifetime. They got all these different things. But it's all based on what you're trying to do. You're the captain of your own ship. You determine how much money you want to put in and what you're trying to do. So here's a perfect example. Age 5. This is where $670 and somebody could be putting in, what is this, $500 per month, or is it $1,000? But either way, the premium is $6,000. This is a premium breakdown, $6,000, and we go over here to the non-guaranteed. And by the way, you receive a dividend. So not only are you earning the 4% interest, but these insurance companies are giving you dividend on top. So when you start adding a dividend into the 4%, now all of a sudden you're sitting there with this thing called cash value, and it starts adding up. So you can see right here, year 2, when the kid is 6, there's already a $10,000 cash value in here. And the dividend was $148 and $315. And look at here. Year 3, we're almost at break even, and we have a cash value, and you can see the increased cash value. So look at here. Let's go down here. The kid is 19, 18, $131,000. Death benefit is up to 1.2 mil, 1.3 mil. How many kids at 18 could use $120,000 of cash value? And you could say, hey, son, so the kid wakes up and says, I want to go to college. Okay, we have a little college fund. Kid wakes up and says, I don't want to go to college. This is what the wealthy families do. I don't have to go to college. Well, we'll just put you in the family business. Or you can start your own business. How? Because you can go down here and take out $50K. You want to start this little business? Let's go see a CPA. Let's make sure all this is legit. Let's make sure you don't lose at your business. We'll try to make sure you don't lose money. Again, ordinary citizens who do not know about this, they're putting their money parking in the 401. Try to take your money out early, you get a penalty. Try to take your money out after 70, you get a penalty. The government siphons your funds. This money right here, this $123,000, even if he said I want $100,000 in a policy loan, guess what? He's still going to earn the dividend off of the $123,000 for the following year. This dividend would be posted into his account. The account will still say we got $131,000, even though we have a policy loan that's tax-free. Are you getting this yet, ladies and gentlemen? And not only that, the most powerful thing is if he passes away, heaven forbid, there's $1 million in life insurance. So now your family is still going to be fine. You don't have to worry about anything, no burden. But how about this? What if all you had to do was 10 years of premiums and then let the premium pay for itself? Look at here. This is why this is $11.49. Look at this. Dividend is $2,000. In theory, or in actuality, you can use some of this to pay this. Now your cash value will be reduced, but you have whole life insurance for the rest of your life for 10 years worth of investing for your child. Now, here we are at 30 years old. $289,000, almost $300,000 if you didn't touch no money nor put any additional money in here. Imagine if you put additional money in here when they were 11, 12, 13, 14, 15. Can you imagine? This would be at over $300,000 at 30 years old. Don't you think your child would be a lot further ahead and be able to do whatever he wanted to, whether it's education, whether it's their own businesses? Risks now change everything. But we're going to go further. What happens when they're 31 now? So we're starting here at 35. And again, you've heard me talk about these paid up in additions where you can get these mini policies. So he's adding, and again, we're dealing with non-guaranteed. And look here, look at the annual dividend at this point. None of these annual dividends are guaranteed. They could fluctuate, but that's fine. Imagine all of that. So now look at here. 55, 59 years old, over $1 million. And are you seeing something here? 0, 0, 0, 0. You're not sweating. You have cash value built up. You're not getting sick. You're working out. You're doing your fitness thing. You're holidaying. Because what did we do? Stop struggling now. Way we have our extra streams of income along the way. So we have an extra 1,000 or 2 coming in just from us doing some extra streams of income, some passions we love. So are we having to touch any of this cash value or even take out any policy loans? No. But if somebody walks up to me and say, hey, I need some private money lending for a real estate deal, and you say, hey, I'll give you some short-term money as long as it's 12% on my money. Sure, I'll give you a $200,000 that you need for that down payment on that $1 million property. And at closing, you can give me back my 200 grand. Or I'll give you interest only. But again, I don't have to trip, because even though I took out 200,000 out of that $1 million cash value, my money's still earning 4% on the $1 million. I'm still earning the dividends on that $1 million, even though I only have 800,000 in cash value. Are you not getting this, ladies and gentlemen? This is why there's a whole bunch of wealthy people walking around not telling you the secret of how they're able to walk around and not even care in the world, because they're sitting there going, yeah, that $2,000-3,000 a month I'm making is fine. That little Social Security check I get is fine. And, hell, at this point, I could just basically almost take out $50,000 a year from my cash value, because you really don't have to pay it back if you didn't want to, and figure out how long is it going to take me to drain $1 million? That's 20 years. But in the meantime, the money's still going to be earning dividends, 4% on the guaranteed on the total amount. There's ways to go with this. And again, talk to these other people. I'm going to try to move this along because I know this is a long video. All right. And here we are now we're at age 70. And now look, almost $2 million in cash value if you just let this thing ride. And how powerful is this? So now your kids or whoever comes to you and says, hey, man, I want to get this apartment complex over here. We need $500,000 down. This is why the wealthy get wealthier, because they're able to buy these big ticket properties that nobody else has that 20% down to buy that $10 million property. You follow what I'm saying? Or the $5 million, what is that? That's a $2.5 million property. We're going to need $500,000 down before somebody will give me a loan for it. Getting a clue yet? All right. And I want to go over some others, but I'm going to skip this. This is if another person was just age 27 and started today. So you can see, and their policy is a little bit different, but they're paying only $5,000 a year. What is that, $470 a month? So in year one, their cash value is this. Non-guaranteed, it's that. And as you can see, At 35, which is 8 years later, they break even because their cash value is 40,000. That's about what they put in at the end of 8 years. 8 times 5 is 40,000, so that's their break even point. But yet, we have a cash value of $40,000. It's sitting there. And if the person passes away, some heirs get $339,000. Less if they have a policy loan. Let's say he took out all 40, then they would get $299,000. So this is the beauty of it. Once again, see, it's never too late to start. And that's only on 5,000, which a lot of people, you can afford $400 a month, right? Some people are doing that right now in their 401k. You can afford that. Here goes some more. Here's a guy 46 years old. He's got a $500,000 life insurance policy. He's 45, but at 46, his premium's $10,000 a year. So he's paying like $830, $850 a month. And look at here again. No cash value first year, because you can design these to have no cash value for a few years, but ideally you want to start creating a cash value right away. But you can design it all different kind of ways. At 47, he has this 845, but then he gets this paid up insurance, which can add more into your contract. So if you are, make more money, you could say, okay, instead of 10,000, I'm going to add another 5,000 in there. But anyhow, he's 50 years old, and here's where his cash value is at 25,000. Some people would say, Eric, that's not good. I understand what you're saying. But at 10 years, it's 74. At 15, when he's 60, he has 134. So it's not too late to do anything. It's all predicated on what you can do. You don't have to kill yourself trying to make it happen. So with all that said, like I said before, go see this seminar here, this master class by Darius and Carmen. It's almost every 15 minutes. I'll have a link down below. They actually do this. They have the license. They are insurance agents. If you want to go with them or find out more after you watch the video, then you can see what's going on here. Or you can also go over here at Better Wealth. These Carmen and Darius are the Wealth Nation, and Caleb is Better Wealth. And you can get an asset report over here with Caleb. You fill everything out, and you answer with an email, and you can put in there, hey, I only have no money to put in right now. I only can afford $200 a month, or I can afford $1,000 a month. Whatever you can afford to put in, which, by the way, if you have that extra income coming in, you have that going on. So therefore, you can use that money to create more money. That's the idea here, ladies and gentlemen. We're creating wealth. And something that I forgot about, which is very important, which I glossed over, was your children. You can pay them. I have an LLC. I employ my grandson. I pay him $600 a month. Instead of paying him $600 a month, I put that into a whole life insurance policy. So he's going to be set in a better place when he's 18 years old, when he's 19 years old, when he's 20 years old. Our family's creating wealth. Powerful. And for my LLC, it's a tax write-off because my grandson works for me. Do you understand what I'm trying to say here? I get a tax write-off from the grandson. You can only go up to $12,000. And I get to put it in a vehicle that will not be taxed. The cash value is not taxable and protected from lawsuits. Some people say, how do people get in lawsuits and then keep their money? Some people say, hey, how did O.J. Simpson get sued because of the Goldman family for millions, and he still has his $25,000 a year coming in from the NFL because he's putting his money into a vehicle that can't be siphoned because of lawsuits. Then he moved to Florida because in Florida you have a homestead laws and some other vehicles, and that's why certain states are friendly for that type of thing. So with all that said, I hope you stayed with me. I hope you got this, but there are books. Go here, Becoming Your Own Banker, Nelson Nash. I'll have a link down below. This is the guy that kind of popularized it a few years back. And this Money Wealth by Jake Thompson, you can check him out. And then there's a lady named Pamela Yellen, the Bank on Yourself Revolution. I'll have links down below where you can go to Amazon. Please use my links. Of course, they're going to be affiliate links. And buy one of these or all of them if you prefer, because this will help you out as well, as long as you understand that this is not considered investment. This is more along the lines of doing what you're already doing. You're saving money somewhere, I hope. You're earning extra income somewhere, I hope. So therefore, you can put this money towards your own whole life dividend policy and structure your family for generational wealth. This is why I always say, there's no excuse. An agent should be thrown in jail when you have these people who are superstars that play sports, who do music, who do whatever, these labels. It's highway robbery, it's criminal when somebody's making 100, 200, 300,000, $1 million, and then 5-10 years later, they're broke. All they had to do was put money in a whole life insurance dividend policy and go buy some dividend stocks. Take $100,000. Good person's like 20 years old usually, 18 years old, 25 years old. Take $100,000 from 2 seasons. First year, 100,000, we're going to put in this whole life insurance policy. And then next year, 100,000, we're going to buy dividend stocks like Coca-Colas, the AT&Ts, the Apples. That's it. You will be surprised. You don't have to do nothing else for the rest of your life. There was no reason for people to be broke after they're superstars and make a lot of money. But there's a reason that happens, because people don't know about this. They rely on these CPAs, these other people who say, nah, we're going to do it the old-fashioned way. We're going to do it the way that makes me rich. Because if I write up policies for you, I get a commission every time I do. I'm not going to tell you how you're going to keep making money and don't need me later. I'm going to tell you how you're going to need me later. So therefore, I get another commission. This is what stockbrokers used to do. They'd call you up and tell you, hey, I got a greatest, latest deal right now. So let's invest in this XYZ company, because every transaction they used to get a commission. They didn't care if you won or lost. When you lose and call up crying, they're like, oh, this is an investment. This is what you knew already before going in, that not everything goes up. Of course, but nobody likes to lose money, especially hard-earned money. So therefore, ladies and gentlemen, I can't say no more. This has been a long video. I hope you got your champagne and everybody in the house is toasting up, because generational wealth is real. You can do it. It ain't that hard. They got you confused. They have you doubting yourself. They have you misunderstanding money. But those at the top, the 1%ers, they're not confused. And with all that said, thank you for watching. Thank you for listening. We went above 4,500 subscribers. I appreciate your support, but you have to share this video, ladies and gentlemen. You have to have your family watch it, because you can get together and make this all work. With all that said, it's hard out here. And we're trying to make it a better world for everybody. Because once you understand this powerful concept, you no longer have to rely on any banks, any mortgage company, any loan officers. Now you've crossed the barrier into being a minority in America. You don't have to worry about anybody saying, because the color of your skin, we're not going to give a loan. We're not going to give you this. We're not going to give you that. You're saying, I'm taking everything I got. Because everybody can do this, no matter where you live, no matter skin tones, no matter. It's just knowledge. And with that said, I'm going to say one last thing. When a child goes to a school, there's a reason why wealthy people all tend to try to make their kids go to the same school or a wealthy school. What you're not understanding is you can go to, let's call it, I went to Sonoma State, for instance. Sonoma State is in Northern California, but it's not Berkeley, it's not Stanford, it's not USC, it's not UCLA, it's not Harvard, it's not Columbia, it's not Yale, it's not Princeton. What you're not understanding is even high school, when your child goes to a school that you have to pay college tuition for while they're in high school, while they're in middle school, what they're paying for is associations. The parents that go to those schools could be ambassadors' kids, senators' children, Fortune 500 company children. And what happens? The children become friends of each other. It's not so much the friends of the adults, but the friends of each other. 18 years old, 14 years old, 20 years old, depending on what school, college or high school or elementaries. When they become wealthy, because their families are wealthy in that same realm, now you pick up the phone and say, hey, what you got going on, man? And now what happens? Your conversation is totally different, because now you're talking about how do we make more money because we have access to funds and we have friends all over the world, because you heard me, ambassadors' kids, senators' kids, federal agents' kids. This is what I'm talking about. Your whole world opens up in a quicker and faster scale. This is why wealthy people tend to keep their kids all in the same type of high-end schools. They can afford it, and that's why it's major, and that's why education matters. So with all that said, keep your head up, keep moving, and I'm out.